Very happy today to have with me someone who probably doesn't need any introduction, but I'm going to ask you one for one anyway. Someone who's very well known in not only the accounting world, but in the small business world as well. So Carl Reeder is still at the ripe young age. You're not 40 yet, are you, Carl?
Not 40 yet. I'm clinging on to my 30s. So if anyone's watched The Office, and I certainly watched it first time round and far too many times on Netflix since, you see that cringeworthy moment in pretty much every episode where Ricky Gervais, as David Brent, says, I'm in my 30s, where he's actually 39. And I'm sat in that position right now.
Fantastic. So not even hit 40 yet, but has achieved a hell of a lot in his career today. So we'll be finding out all about that in today's session. How essentially the topic for today is how to build an accounting firm that can run without you. So everyone here should be an accountant, because if you're in the group, then you'll be an accounting firm owner. So in terms of the audience for your help, Carl, is going to be accounting firm owners, maybe startups, but typically established owners with a couple $100,000 in fees, going up to probably $1 million, and a few outliers with more than $1 million, just to give you some context about the audience that we have here today. But as per usual, guys, let me know your questions, put them in the comments so I can ask them to Carl. But just to kick us off with, Carl, give us a brief introduction about yourself, and we'll take it from there. So essentially your accounting journey, when you first started your accounting firm.
Sure. Well, first of all, thank you so much for inviting me to this. And you mentioned that I don't need introduction, but I'm absolutely sure that I do. And that's mainly because I enjoy talking about myself, quite bluntly. So I'm creating the opportunity for an introduction. But thank you so much for letting me speak to the group. And I really do hope that in some way this helps each and every member, even if they can just take one nugget of advice from it. So as said, so I'm Carl. My accounting journey was quite accidental, I think would be the way that I would sum it up. So I took a very strange route into accountancy. I left school at the age of 15 and started a YTS in hairdressing. So it didn't go too well. I did that at the point that I got my national insurance number. So I remember vividly getting my national insurance card back in the day that you get the card in the post. Right. And I hated school, absolutely hated everything about it. I hated the structure. I hated the fact that I like to sit down and be quiet. I hated the fact that I like to do homework. I hated the fact that it was a boys' school. All of this stuff I didn't enjoy. So I went out and tried to create my own way in the world, and that lasted 6 weeks. So I went back to school just to do my GCSEs about 3-4 months later, which was great fun because I was able to go without a uniform while everyone else was in uniform and so on. But then I was at the point where, I had to work out what to do with my life. And if you can imagine, at that point, I was 16. I had moved out with my girlfriend at that point. She'd become pregnant. And I told you it wasn't the usual route into accountancy, didn't I? I was working 2 hours a week at a supermarket, stacking shelves in the dairy department. So I had to get a proper job and had to do something to be able to pay the bills. I couldn't keep going on selling stuff at cash converters and so on. Had to do something to pay the bills, keep myself busy as well. But there was no real intention of doing anything to further myself. It was just about getting a job. So I applied for the first 3 jobs that I saw in the newspaper, which one of them was in the army and 2 of them were accounting firms. Got turned away from the army for being underweight at the time, believe it or not. But I got offered the 2 jobs at accountancy firms. And to put that into context, I had no idea what an accountant was. I had no idea what accountancy was. I, before my first interview, went to the library in Leigh-on-Sea and actually read a careers book to find out what an accountant does and regurgitated it during the first interview. So I was very fortunate to get into accountancy, first of all, by an unconventional route, and secondly, to get into accountancy at a time when 16-year-olds and certainly those without A-levels were accepted into the profession. Because obviously a fair few years before, you had to go through articles and that process. And certainly just a couple of years afterwards, most employers upped their minimum requirement to A-levels. So I was in a very fortunate time banding, but I was able to get in, do the AAT, and then go from there. So I joined a firm in Essex. It was a fantastic firm, very small firm, but learned a lot. Probably the one thing that I learned more than anything was that I didn't enjoy accountancy. And that was a really defining moment when I realized, maybe 1 or 2 years in, but I wasn't very good at it. I didn't particularly enjoy it. But there was actually some parts of the role that I really enjoyed, which was going out, meeting people, at that time, training them on Sage Sterling. So taking their big red accounting cash books, converting it into computerized records. I joined D&T as a staffer in 2002. At that point, there was about 8 of us, I believe. I was gifted a bunch of clients that nobody else enjoyed working with. So this was martial arts schools. There's about 25 of them, and they were based all over the UK. And I just went out and met them. And we put online accounting in place for them because they were based in, far-flung locations. Furthest away was Inverness. We had Belfast, we had Cornwall, and we literally had all 4 corners. We put online accounting in place purely to save discs getting broken in the post, rather than any of the current talk about connecting data and all of that stuff. That was the furthest thing from our mind. I built that portfolio up to about 250 martial arts schools in the UK, which would probably be 75% of the market. And along that way, learned about niching a practice. One of those schools decided that they wanted to franchise. So I went to a franchise expo with them back in 2004, I think it was. Just kept turning up to these franchising events, took on our first major name franchise in 2007, which was Stagecoach Theatre Arts, who are still clients of ours today. Realised that we'd struck gold along that way with what we could offer in that world, and built it to the point we are now, where we've got about 3,000 odd clients. We're embedded in most franchise systems as the network accountant. Alongside that, there's been a personal journey as well. So that's the business story, so to speak. There's been a personal journey as well. It was about 2004 where my second employer, D&T, realised that I wasn't really cut out for accountancy either. So it was noticed at my first practice, and I started doing training and just bits of everything. 2004, I downed tools insofar as being an accountant, and had to go through a process of learning on the job to be a manager, learning on the job to be a salesperson, learning on the job how to do marketing to feed the salespeople, learning on the job how to build a team. And around 2013, I stepped away from the day-to-day workings of the business altogether.
Sorry, Carl. Can I just interject? I think there's a bit that's been missed. So you joined D&T as an employee. Then when did you actually become kind of, one of the owners? How was that route to kind of?
So that was in 2007.
Okay.
So we had a founding partner who wanted to leave. There was 3 others of us at the time. We designed an exit route for him that took quite some time. And there was actually a challenge in that as well, which I'll share very openly. Because of my age at that time, bear in mind, in 2007, I was only 26, and not many people get the opportunity to buy into what was a traditional practice at that point. So unfortunately, it was done. So the deal was done in 2007, but I came on board as a partner the day after he came off as a partner. So there were some politics around it, and I think that was 2010 that switchover took place. 2007 as well was when we took on Xero, because Iris, in their infinite wisdom, decided to pull out the online market. They felt there was no future in online bookkeeping, so we brought Xero over to the UK, helped adapt GST to VAT and all that kind of stuff. But yeah, I was going through the process of downing tools to becoming new prospect facing only. And then from 2013 was when I had a true business development team and was able to step away from all of the day-to-day workings of a business and focus solely on really, I guess, building out the leadership side of a business so that could be replicated by an executive board, which we've got now, but also refining the management process, because we made the same mistakes most firms do of promoting accountants to managers because they've been sat there the longest. So we had to re-engineer all of that. And also, of course, the continual innovation that we've needed to ultimately protect our marketplace.
Excellent. Okay, so that's a very fascinating journey, Carl, and amazing how you got to sort of partnership so quickly at the ripe old age of 26. So that's a fantastic achievement. We probably, you said 2007, so I bought into a very traditional firm in 2008, so a year or two. Talk to me about that journey from sort of 2007 to 2013, where you were in that partnership position, and before you were able to step back. What are the kind of things that you did? So, everyone on here on this call wants to know the how. How did you actually start the process of building the accounting firm to run without you? So talk us through what the kind of the systems and the structure were like, and where did you start first? Did you start on the systems? Did you start on developing the people? What did you do sort of practical steps that, people
Sure.
can hopefully take away and learn from?
Okay, so there was a range of things, and I think it's important to remember at that point I was in a position where, whilst I wasn't doing existing client work, I was still winning work.
Yeah.
And that I cannot understate the importance of winning work in order to be able to build a practice that means you can step back. It's all well and good systemizing and doing all of that stuff. But if you haven't got the turnover, which delivers the gross profit, which delivers the net profit for you to be able to employ someone to replace yourself, then actually you can't step back. So whilst that's the opposite of most business rules, which, the business rules are you work on your client fulfillment, then you work on your conversion, then you work on your generation. Actually, we was doing everything at once. So it's myself and my business partner, Ben, and without realizing, we had between us the rocket fuel principle of the visionary and the integrator, in that I had the idea of where we were going, the path that we were heading down, and he was very good at communicating that vision to the team and translating it and so on. The actual steps and I guess the how-to behind it. So the first thing we've always had as a golden rule is that we've always overstaffed our management team. So we've always gone beyond where the business would reasonably justify it should be. So, for example, when we had about 1.2 million turnover, we had a team of 4 managers.
Okay. Now, and employees, how many people under those managers?
I'm going to guess a total of 30 of us at that point as a guess, but that's, I wouldn't know. The challenge with that with having 1.2 is clearly your profit levels are much lower because you're paying decent people to be following a process and so on. But we took the view that actually we're very similar to a warehouse, and you wouldn't order stock if your warehouse isn't big enough. So if we were going out winning work, we had to make sure that we had the capacity to deal with it in terms of people and time and all of that stuff, but also that we had the capacity to run a business at that level as well. Because we were hitting some quite big growth numbers, and there was a very real risk of overtrading through that process. And not just overtrading from the accountancy perspective of your marketing's costing you too much and you might be profit rich but cash poor and so on, but actually overtrading from the commercial perspective that we could be running before we could walk. So we at first promoted accountants to become managers. That was a huge mistake, quite bluntly, because they didn't necessarily have management skills. Some did, some didn't. So there was a lot of natural selection along the way, and that team has changed considerably. But also we learned in that process that the phrase manager in an accounting firm actually covers some quite contradictory roles. And one of them is the role of the internal process manager versus the role of the external relationship manager. Where one of them, you really want bat in your client's corner and making sure that your client's loved and, you got all the time in the world to serve them and all of that stuff. And then the internal process manager, who should be focusing on pounds, shillings and pence, should be focused on profitability, which is diametrically opposite to the relationship manager. So we found that we needed some separation there. And we found other areas as well where we had to separate out the roles. and really get clarity on roles, responsibility, job descriptions, and so on. And I'm going to open up another thing, which I might be jumping about here, but I'm just saying it as it comes to mind. The other thing that we really wished we'd have done back then, but we did far too late, was setting our vision, values, stakeholders, and so on. And it's the kind of stuff that I saw during my accountancy training as kind of just management nonsense, to be honest. I got it, but I didn't think you had to go through the process. It was like, well, clearly you need to know where you're going, but I didn't actually go through the process or engage the team in that process. Doing that as a formal exercise and engaging the team on setting the values, and the realization that the values of the team were slightly different to my personal values. They weren't conflicting, but the priorities were different. And all of that stuff really helped solidify the engagement around the management team.
Brilliant. So a question I get asked a lot is, how do you know, or when do you know when to start adding additional members to your team? So you mentioned that you were clearly overstaffed because you knew you were winning work and you wanted to have the team in place to be able to deliver on all the promises and all the new clients that you had coming in. But did you kind of have a ratio in mind? Clearly you're running a business and you wanted to generate profitability, but you knew looking ahead that you had to invest in people. Was there any sort of multiples that you used in your head to know, okay, we've got 30 people at 1.2, we're going to stay at 13 to hit 1.5, or we need to hit another 10 people to make sure we get to 2 million? What kind of things were going around your head to help you make those decisions?
Sure. So back in the early days, we were using timesheets. So that helped the decision in terms of one of the ways that you could get to your turnover was to look at your capacity multiplied by your notional charge out rates, which are a load of nonsense, but it gives you an idea of the people versus the turnover. You can sanity check that back against total fees, and you could see whether you're somewhere handy. What we do now, we focus far more on throughput. So we look at jobs in the pipeline when they're due to land, the capacity we've got from people to push them through the system. But really, there's a number of measures that go into it from a technical perspective, from a technical staff member perspective. We also, in the business development team, we look not so much from a capacity perspective, but more of a skill set perspective. And we have a very broad, well, I say broad rule of thumb. It's probably more specific than many firms, but for every 44p of marketing spend, we need to get £1 return. That's the ratio that we use. I know that that's much lower than where most firms would target, but that's because of how embedded we are in our niche. We've built that luxury, I guess. So we have to make sure that a salesperson can return that return on investment, but also that they're filling in a skill set that's not there in the team already. So we started with jack of all trades in that world, and we've gone down to being more specialist. So, for example, specialist content creator, specialist copywriter, specialist salesperson for telephone sales, specialist salesperson for franchisor sales. But in terms of rule of thumb ratios for the general team, it's on workflow, but it's also looking at the pressures that the team are under. Are we getting murmurs that they're about to be busy?
Brilliant. So I guess, it sounds as if, so what's the turnover of D&T now at the moment, roundabout?
So good question with COVID. We've got no idea this year, but we're broadly around £2.5 million.
Okay, so let's say, taking you back to your days when you were hovering around the £1 million level, what did your structure look like? So you mentioned you've got a management team, and then you've got, I guess, the team members who are doing it. Did you have a certain ratio of managers to team members? And when did you start to, or what were the first roles that you created? Because now you've got specialists in marketing, etc. So it sounds like it's more of a corporate organization. But when did you start to actually? What roles did you create, and when did you create them in your journey?
Okay, so very very simply, we created a management tier. We had no strict lines of control. We didn't look at each manager's span of control. We didn't look at pods or anything like that.
Yeah.
We just promoted 4 people, gave them an extra £5,000 each, and hoped for the best. I might as well be honest about it. And that was an unmitigated disaster.
Yeah.
So we had myself and Ben. So by that point, the third partner had kind of gone his own way. He was still in the business, but not, if that makes sense. Myself and Ben, very broadly, Ben looking after the ops, me looking after the vision, the team of 4 managers who had division of clients, but not division of team members, and then the team members. That was, as I say, a disaster because you had a lot of crossover. You had a lot of generalists looking after a lot of generalists, and it didn't quite work. Where we've moved to now is we've looked at Reinventing Organizations, a fantastic book by Frederick Laloux. I don't know if you've come across that, but he puts forward the basically the pod management system. So we use a pod management system with pod leaders and so on. But also from a bigger picture perspective, you touched on commercial, and that's why I want to come back to that point. We've decided to make the business very commercial rather than an accounting practice. So we have all of the roles. You have a CEO, the COO, etc. But we also have a CPO, the Chief Practice Officer, which is effectively the senior partner in most firms. Now, the challenge that I see most firms have is that they conflate the role of senior partner and CEO. And quite frankly, you don't want the senior partner being the CEO.
Definitely.
You know, from a commercial perspective, that just doesn't work.
Yeah. What is, someone is asking here, Carol is asking, what is a pod system? If you could just kindly explain that.
Yeah, sure. So, I mean, our interpretation of a pod system is actually a business that could run itself. So we have all of the disciplines within the business within one pod, and they have team targets that then can be taken down to individual targets. So the pod is effectively its own practice. Where we're trying to move towards, but it is a continual process because we've got team members who've been there longer than me. So the change management is really quite tricky on this. But the eventual goal is for the pod to determine what their own strategy is, even so far as what their own values are and so on, as long as it's in line with the overall business direction. They would set their own turnover targets, have their own P&L, and effectively run as a business within a business. So they would utilize shared facilities, but actually would run almost as a micro accounting firm within a bigger accounting firm. The book Reinventing Organizations, I highly recommend the picture version because I'm no good with words. But, you know, I find that just seeing the picture of how it's structured is far better than reading 100 pages of words. Because you can get it quite quickly. But it was trialed, I believe, in Sweden in their health service. And the health outcomes were far greater than the traditional way of working. So if it can work in a health system, it can definitely work within a business.
Definitely. And typically, how many people do you have in your pods? And in terms of the metrics that they are charged with, you say they're responsible for their own P&L, etc., or are they given a directive from the management team that you guys need to generate X amount of revenue and handle X amount?
Absolutely. So they're given a directive of what they need to contribute towards the overall business, but then it's down to them how they achieve it.
Okay. And typically, how many people in the pods?
6.
Fantastic. And that is in your view, that's the optimum number to have in a pod, or would you go more or less?
We don't know because we've not tried anything else. However, 6 was based from a couple of angles. First one, the old management theory, which I don't know if it's true or not, that the ideal span of control for a manager is 5 people. So manager plus 5 seemed to make sense. But also it allowed us to have enough variety of the roles within. So we could have a tax specialist in each pod. We could have an apprentice in each pod. We can have a customer service coordinator in each pod and so on.
Fantastic. Good stuff. Charlie is saying, which book is Carl suggesting? That was Reinventing Organizations, wasn't it?
Yes, it was. Let me just turn. I've got it on my bookshelf so I can show the copy as well. He says, no, I haven't. I can't. Here we are. So it's this book here. Fantastic book, but don't go for this one because it's loads of words. There's an A4 picture version that's much better. It just doesn't fit on my bookshelf.
Brilliant. Thank you. So, Carl, there's another question here, which I was going to touch on as well about your client types. Now, I know, like me, you're a fan of niching your accounting practice. So talk to me about whether D&T was already established as a niche provider. I think franchising is your niche, isn't it? Was it already established as such, or did it evolve over time? And, what is your advice for other firms who are not quite there with niching, and why they should consider it?
Sure. Okay. So no, it wasn't already there. But I'm going to answer first so that people don't switch off whilst I'm talking about how to do it. I'm going to answer the why you should do it first, if that's okay. And it's an absolute no-brainer. You must do it. Ignore the... I'm going to use a very friendly term here that might seem disparaging, but the idiots who say you shouldn't niche just to get airtime and contribute to a conversation, because it makes no logical sense whatsoever not to niche. Look, any business has a definition of who their customer is. Now, that definition might be wide, it might be narrow, but quite frankly, if you feel that you can sell anything to anyone, and you genuinely mean that, if you genuinely think that you can serve a taxi driver in the same way that you can serve Apple or Google as a client, then you're deluded, because you just can't, and no business can. If you take, let's say Debenhams, they have a certain demographic that they see as their customer. It might be a wide demographic, but they have a demographic, they have a product range. You wouldn't go into Debenhams to buy, I don't know, a hammer and some spanners. You go to B&Q. So you have, every business has a definition of who their customer is, what their product is, that product market fit. And it's just, the conversation is more about how tight you define it, whether you go hyper defined like we did at first, or whether you have a more general niche. So so first of all, don't switch off at the word niche. Everyone's got a niche. You know deep down you've got a niche, even though you might think that you're not a niche firm. There is the fear of many firms that if they niche, they're going to have to turn away customers and so on. It doesn't matter. It really doesn't matter. So the two niche markets that we've had, the first one was kind of there when I joined D&T, but it wasn't identified as a niche. It wasn't big enough to take forwards as a niche at that point. And that was for martial arts schools. And that is what I would call a micro niche. So you've got a niche market. And in that world, that niche market could be education businesses. And then a micro niche is the next layer down, where you really refine who it is that you serve. And for me, I'm a huge fan of micro niches. I know most firms aren't. And this is where I agree that there's more of a debate to be had about whether, for example, you should focus on medical businesses or whether you should focus on vets who've got locum staff members. I would be the one who would focus on vets with locum staff members, but many firms will just focus on medical because they feel they need a bigger market. In our experience, certainly with martial arts, the total addressable market, we believe the contribution to GDP in that world was 25 mil. We believe that the addressable market for us, so that is the businesses that saw themselves as businesses rather than hobby clubs and that had a turnover of over 50 grand. We believe that there was maximum 500 in the country. And the way that we saw it was that, if we can get 20% of them, that's a good slab of clients. We actually got to 250 and we realized that our predictions on addressable market and so on were totally wrong. And it was actually a smaller market than we expected. But it gave us a portfolio, or certainly it gave me a portfolio that justified my positioning to buy into the business. I had a bigger client portfolio than one of the partners that just exited. So it put me personally in a good position, but also from a business, we had a very profitable client base as well. So what's the best way for me to answer this? Should I talk a bit about the commercials of the niche before how I did it? Or would you like the how I did it and then the commercials?
Yeah, go for the how now first.
The how.
Yeah.
Okay, so what we did, we had this bunch of clients, and as I say, it was a handful of them. And it was because one of the partners trained as a martial artist, knew somebody, helped him with his VAT. He told his mates, so a few people came to the firm. And this is how most niches start. I helped advise the WOW company on how to get into their niche of creatives. And it was because they had 5 or 10 creative businesses. And I remember meeting Paul Bulpit over, I had a bacon roll. He's a veggie, so I can't remember what rubbish he was eating. And I said, why aren't you niching? Most firms have got 5 or 10 clients in an industry, but the accountant enjoys working within. They're people like them, they radiate the same energy and so on. For me, with martial arts school owners, they were, this sounds horrifically offensive to say this, but it's true. They were blokes who were my age to 10 years older. So I naturally resonated with them more than I would maybe a 70-year-old chairman of a limited company who always has to wear a suit and tie. So I had more rapport with them quite naturally. I quite enjoyed the fact that they were into their personal development and I was too. So there was a natural area of conversation outside of business. I found it quite cool what they were doing. I'm not a martial artist, but I found it really cool the stuff they were doing and the change that they could affect in kids, most importantly. So there was just a natural resonance between me and the clients. So that was kind of how we identified the niche, how we then expanded it. We set up a niche website, martialartsaccounts.com. I doubt it's still going now, but we set up a niche website that was focused solely on the martial arts schools. We wrote in the trade journals. So I got to know the trade journals, wrote articles, got to know the key industry influencers. So that included the people who run the associations of martial arts school owners. That included the national governing bodies. That included the direct debit collection agencies, and it included the manufacturers and wholesalers of equipment. So got to know them, visited them, become friends with them, and got referrals that way. We'd also ask our clients for referrals. The next thing, and I think this is an important point, there's a lot of talk about niching from a marketing perspective. And yes, you need to market to your niche, but you also have to service your niche. There's no point having a niche if you can't deliver specifically for that niche. So we had to learn the workings of a business. So I just sat back and listened to a lot of school owners about what were the key revenue drivers in their business, how many students could they train in a certain size location and so on. And I got to a point where when I was going to visit a school, I would be able to tell the demographics of the area just through driving through, and I would know whether they would work for a martial artist or not. I would know even simple things like where their dojo was in relation to a major A road. It sounds really simple when you say it, but you don't think of it as an accountant at first. What is far more useful for me to know is the fact that people who live on the other side of that A road aren't going to go to that school. It just doesn't happen because human behavior, you don't drive around a road, turn back on yourself to go somewhere. We learned the radius that students come from when they're in, we learned the number of students per square footage and all of this stuff. And it allowed us to have really intelligent conversations with our clients. So what I call true advisory, their VAT and their tax and all of that stuff was irrelevant. Yeah. They actually, the business owner didn't really care about it as long as they were forewarned and forearmed with what was coming. What they cared about was the fact that we could talk them through each year how to build their business, how to solidify their business, what other school owners are doing that they're not, where they could potentially find better suppliers for their kit, not just on price, but on those things that you can't really quantify with a number. So quality of kit and all of that stuff. It was more important for us to be able to talk to them about the latest dojo management theories. That was the stuff that they wanted from us. Yeah. So that was the how. We got to know all of that stuff. And then the second stage of it, so that kind of gets you in the game. And most accountants in most niches, in honesty, only do 10% of that. They might write a couple of articles and do the marketing, but they don't truly embed themselves in the world of their client, in my experience. The next stage of that is to close the door behind you. So that opens the door for you to become a no-brainer for any client. So, we were charging average fees of 2.5–3 grand for these school owners, and a good proportion of them are still clients of ours, even though we're not actively in that world. We would charge 2.5–3 grand when a local firm would charge them 500 quid. But, the extra couple of grand's worth of business advice we were offering totally paid for itself several times over for them. The tax and the filing of the accounts and the cash flows and all of that stuff and putting them on the online accounting, that was a commodity, but we brought some real specialism. Once you're at that stage, you then got to close the door. And that's, so in the martial arts world, we did that through, I became a founding director of the federated body for Taekwondo, became a director of the national governing body and raised the Olympic funding for Taekwondo as well. We got involved in the standards agency, which is not for profit. We did loads of things that basically put a load of barriers to entry for other accounting firms so that nobody could come in and be the next martial artist's accountant.
Yeah.
And we did the same in franchising. Exactly the same in franchising. We worked out what we could offer. There was also a bit of a technology play there as well. So we had to build our franchise dashboard and other tools that could go in. We ramped up, made a load of noise, and then we closed the door behind us.
Fantastic. Yeah, no, I'm with you there, Carl. In terms of, niching, it's so powerful. And there are many reservations that accounting firm owners have that, if I niche, then I'm going to close the door on so many opportunities, but actually you'll open the door on many others. And chances are that those others will be a lot more profitable than the ones that you have. Because, let's face it, you cannot, when an accounting firm owner says, so who do you serve? Well, I serve small business owners in business in the UK. There are 5 million businesses in the UK. You cannot possibly serve all of them.
Exactly.
So you have to kind of, really knuckle in and hone in on who it is that is your target audience. Because
completely.
If you do that, then you'll have your ideal client. And that means your marketing can be so much more laser focused. And you started in the world before Facebook. Now we have Facebook ads and other methods of getting directly into the households right in front of our target owners to be able to speak to them in their lingo, which is what you did.
So let me support that with a couple of stats. So D&T is based in a town called Swindon. There's for the business size that we'd be looking for, which is roughly 250,000 turnover up to 2 million, I think. The last time we did that database, there was only 1,000. We expanded the database. So we went down to VAT registration and up. There was only 2,000 businesses. There's 60 firms of accountants. Okay. You don't need to be an accountant to realize that being a player of one in a market of 500 is far more advantageous. Or, like we've got in franchising, being one of 3, but being by far and away the leading firm in that world in a market of 40,000. And that's where it just works. Because the other challenge is, if you don't go down that route of niching, you struggle to get referrals, because whilst you might feel that you've got a great relationship with the local bank manager, they're having breakfast, lunch and dinner with every firm close to you. That's the reality of it. And they might say they love you, but they're promiscuous. And we know that, let's say the martial arts world, if a martial arts school owner is speaking to another martial artist or one of the suppliers to the industry or their payment bureau or their association or their national governing body, they're going to get referred to us. It's that simple. So that's why we've driven our cost of acquisition down so far, because in our 2 areas, we are the go-tos.
Fantastic. No, I couldn't agree more. It's, even when you've got a very micro niche in martial arts schools, but clearly, you've made a success of it just in that. Ours is property, and, people know that we are the specialists in property, and that's where we get our referrals. You're able to charge a lot more because people see you as the specialist. Just think of, a GP versus the brain surgeon, who earns more. And just the mere fact of putting yourself out there and saying that I am an accountant for X industry, automatically you are seen as the expert and people know who your audience are, and you're much more likely to get highly qualified ideal client inquiries.
Yes,
because they feel like you get them. You're speaking their lingo.
So let me give you a perfect example. You touched on at the start that I do a lot in the small business world, and I do, but that's not to win every small business as a client. So if I talk you through our funnel from that perspective, So I've got my new book, Boss It, which is coming out in October. We've got the Facebook group, the Boss It Small Business Community, and a few other very general small business, young enterprise, loads of small business activities. The Facebook group is where we're directing people to at the moment. And that's up to about 2,500 members. We've got quite good engagement, and that's only after a few weeks. So it's really taken off. But you know what? We've got, on the face of it, we've got competitors in that group. But also, let me tell you, we don't want 99% of those members as clients of ours. It's not just a case of they're not in our niche. We don't want them. Okay. Other accountants can play in that group and can pick off the ones in their niche, because we then filter down. We've then got a second Facebook group, the Franchise Mastermind. So if anybody's thinking about franchising, they go into the Franchise Mastermind, where then the members will talk about my book, for example, and they'll share content that I've done previously around franchising. Then from the Franchise Mastermind, we bring them down into our funnel. And I think the challenge that many firms have, even if they've superficially got a niche, is that they dive in for third base straight away. And actually, if you're going to get married to someone, and the average client life should be longer than the average marriage, if you're going to get married to someone, you want to get to know them first. You want to make sure that it fits. And for us, that fit is them being in franchising.
Yeah, no, absolutely. Yeah, I mean, it's a common challenge for many accountants who say, you know, we want to win new clients. How do we win new clients? How do we get more inquiries into our firm? Well, that's the place to start. You know, if you don't know who your target audience is, if you don't know who your ideal client is, then, you know, your marketing is just going to, you know, it's going to be like a little drizzle everywhere and no one's really going to get it. It needs to be laser focused, and the starting point is that ideal client.
So let me tell you as well, the example of how closing the door can really protect your income going forwards as well. Because I think that's an important part of the niching equation that not many do. As I say, there's a lot of talk about a marketing niche and focusing on the promotion side of it. But if you don't get the business of niching right behind the scenes, then all you do is you open up the idea of a niche to your competitors. When you close the door on it, you get to a point where we've had KPMG, PwC, Tenon back when they were going, Deloitte's, they've all tried to enter franchising. And they've got a big carrot to enter franchising because they can do the head office audits as well. You know, our clients, Stanley Black & Decker, who else have we got? We've got Anytime Fitness, Centrica. You know, there's some real big players there that the big four would want to be in for the audits. Now, PwC did their due diligence on it and decided not to go for it. Deloitte actually employed someone to do the due diligence on a whole new project through their Propel thing, decided not to do it. KPMG had considered internally to acquire us, decided not to, tried to compete and lost a 7-figure sum in doing so. You know, we've had people come and go. And the reason is we made sure that we were so tight within the industry that no one could replace us. It's that simple. Yeah. So it's not just about saying you do it. It's about becoming tight in the industry, finding a true value proposition that's over and above what any other accountant can offer, and shutting the door behind you.
Fantastic. Thank you, Carl. We're approaching the end of our time here. We could talk for hours, I'm sure. But unfortunately, we're going to bring it to a close. So a couple of final questions here, if you could include the answer to those in your wrap up. So if you leave the audience with your top 3 priorities that an accounting firm owner should work on to build a firm that can run without them. And in that, if you could just answer a couple of questions, one from Emily on, for a sole practitioner with freelance bookkeepers, what role would be your first hire? And Carol is asking, Carl, if you were starting a practice from scratch today, what would be your priorities? So, you know, to get to where you are today. So 3 top priorities, but also answering who your first.
Also answering those. Wow, that's going to be a tough one. So let me just start with Emily. Who would my first hire be? If I was starting a practice today, I think I'd be questioning whether I need to hire, to be honest. I would be looking at a blank canvas approach, and do I go down the hiring route, or in terms of a traditional accountancy hiring? So the traditional accountancy hiring path would be an assistant who can do the donkey work while you get on with seeing the clients. But I would actually, if I was in the position of having a blank canvas and deciding where to go with the business, I would actually be considering, well, do you know what? Do I outsource the lot? Do I look at offshore? Do I look at nearshore? Do I look at having a distributed network? Yeah, I would be looking at all of the different options, and I'm not so sure that the answer that I can give you based on my experience is the right answer. But for a traditional firm, and if I was starting 10, 20 years ago, it would have been to take on an assistant, then to take on another assistant, then an administrator, and to scale up that way. So the second question, sorry, is what would I do if I was starting a practice from scratch?
Yeah.
Okay. If I was starting a practice from scratch, I would avoid the temptation of working with the friends and family who say, oh, that's great, you're becoming an accountant, can I work with you? That's the first thing that I would do. I would avoid doing that because it leads to discounting, it leads to emotional challenges, and it sets your relationship with your clients off on the wrong footing because you're going to start straight away with Friday evening phone calls. So actually, what I would be doing is I would be following the process. It's a process I set out in my book for general small businesses, but as an accountant, you are the general small business. Dream, plan, do, review. So I would set out the dream really clearly. Where do I want my business to be? What do I want it to look like? Where would it be 5, 10, 15 years time? Who will its customers be? Which industries will it serve? What good will it do in the world? All of that stuff. Then bring it into a plan. So this is where you become a spreadsheet millionaire and then wake up and do it seriously. But build it into an actionable plan and then go about building it as a arm's length business rather than as a service to friends and family to begin with. Because if you go about it intentionally as an arm's length business, you're far more likely to attract the customers that you're going to want in 5 years' time. If you do it as a favor to friends and family, the challenge you've got is the most distance of them. Let's say the brother-in-law. You're doing brother-in-law's accounts and he said, well, look, I was paying someone 200 quid. And you said, well, I'll do it for 175 quid. Then he refers his mate. And you're in a position where there's more month than money. You think, yeah, I'll do it for 175 quid for you as well. And then he recommends you to a few more mates down pub. And all of a sudden you've got a very unprofitable practice, which can't be sold. It's got no clear USP. So rather than just knuckling down and getting clients, I would actually be very intentional on how you design your practice, plan it. And it's tougher and it takes longer to get your first client. But with that intention, I can guarantee that that client will be more valuable. And what it will also do as well is it will set you up emotionally for only working with those clients that deserve you. I was going to give 3 top tips, wasn't I?
That's right.
Yes. So 3 top tips on how to scale your firm so that it can effectively work without you. Mm-hmm. The first one, and by far the most important, is to get over yourself. I think that the challenge many firm owners have in delegating, from what I've seen, is that they believe their team can't do it, or they believe they can't hand on the relationships, or that their clients need them and their clients will leave if it's not them. And all of these limiting factors in your own mind. And the reality is you have to have a level of trust in your team. You employed them for a reason, and that reason is that they're better than you. And not necessarily from a technical perspective, they're better than you because they can win work, they can keep work, so on. So that's the first thing, is to get over yourself and to allow your team to do what you've employed them to do. The second thing is, if you're looking to get out of a business, you need the team firing in the same direction as you. And it's really challenging to keep a team on the same direction without clarity of vision and values, without clarity on who the stakeholders are, and also without that joint engaged voice. So make sure that when you recruit people, you recruit slowly rather than the first person that comes along. Make sure that you hire on who they are. The 3 questions that I always ask is, first of all, will they do the job? Secondly, will they fit into the team? And only then do I look at skills, because the skills are absolutely irrelevant. Skills can be taught, personality can't be taught. And one of the traps we fall into as employers in general is that we hire quickly and then we fire very slowly. And actually, most firms or most businesses hire on skills but fire on attitude. So we need to make sure we flip that equation around to get the right people in. keep a very firm eye on your culture and your staff engagement. We use external staff engagement surveys to make sure that engagement levels are spot on. You want to make sure that in our world that you're not just top quartile, you're top 10%. If you're not, then it's probably not at a point to step away and let it run itself. So yeah, you really need to work on the people and embracing that side of things. And then the third thing that you need to do. So I've said you need to get over yourself. I've said that you need to really focus on the culture. The third thing that you need to do is you need to accept that you won't get it right first time, second time, third time. There's still occasions in D&T where I need to dive back in. So thankfully, there's only been one since I stepped away. So I stepped away Feb 2019. And the occasion where I stepped back in was COVID. It was my natural adrenaline rush. I felt, you know what, I need to dive in. I need to check what's happening. Didn't spend too long, but I probably spent a couple of days on the business, which was a couple of days more than my executive board would have wanted me to. So you need to be prepared to step back in, but more importantly, prepared to bite your tongue. And I'm having to undo that process and step away gracefully, which maintains my ego, which is significant, but also allows the board to get on with what they're tasked to do. Because, you know, it comes back to that first point of getting over yourself. You need to, you really need to set the vision, but let your team get on with it. And possibly that is the toughest thing, is when you see stuff happening or questions being asked, which isn't in the way that you would do it. Unless it's £1 million issue, don't get involved. If it's a £1 million issue, then dive in and fix it. But if not, the damage to your team is far greater if you step in. So an example of this is, let's say that you disagree with the way they've dealt with a client. Yeah, let's say it's a credit note for £2,500, for example. Now, £2,500 is £2,500. Yeah, that's a lot of money. That's a holiday. So £2,500 is a lot of money, and that comes directly out of my pocket. However, the cost of undoing me overriding or undermining my board's decision, their management team's decision, the cost of me diving in the street, speaking directly to a team member rather than following the same channels, is far greater than £2,500. So you've unfortunately got a choice between bad and worse. And it's best, unless it's a £1 million issue, to step away, put your fingers in your ear and hope for the best.
Fantastic. Carl, thank you so much. It's been an absolute pleasure. Some great nuggets of wisdom there from Carl on how to build your accounting firm so it can run without you. Really appreciate you taking the time today, Carl, coming on here. And I'm sure if there's any other questions, then hopefully if you tag Carl, he's in the group, and I'm sure he'll be graceful enough to answer, because he's always happy to help, aren't you, Carl?
Of course. Thank you so much for the invite.
Fantastic. Thank you very much, everyone, for watching. The recording will be in the group, so if you missed it or you joined late, you can carry on and start from the beginning when this is over. But until the next time, thanks, guys. Have a great rest of the week, and we'll catch up soon. Thanks again, Carl, and I'll catch up with you soon. Take care.